It's like 6:30 p.m. You're standing in the kitchen, right? You're bathed in that harsh light of the refrigerator, just staring at some wilted spinach and maybe a questionable jar of salsa, and you are just wishing dinner would magically cook itself.
Oh yeah, the classic fridge stare down, we've all been there.
Oh, yeah, the classic fridge stare down. We've all been there.
Right. It's such a mundane, everyday problem for you, but solving that exact standoff has quietly birthed this multi-billion-dollar
Mm.
algorithmic food industry. And what's wild is that this industry, right under our noses in 2025, just pulled off one of the strangest financial disappearing acts of the decade. I'm Jack,
And I'm Misha.
and today we are taking a deep dive into the official HelloFresh 2025 annual report, because our mission today is to, well, dissect how this massive global food company fundamentally rewired its entire business model over the last year.
Yeah, we are going to unpack the ultimate paradox of their 2025 financial year because, over the course of the year, this company intentionally lost millions of orders. They just let them go. And they watched their overall revenue drop by over 11%. Wait, on purpose?
On purpose. Yet somehow, through this series of, really ruthless operational cuts and pivots, their underlying profitability actually increased.
Which just completely defies conventional business logic. Like, you shrink your customer base, you make less top-line revenue, but you somehow walk away with a sturdier, more profitable company. So we're going to find out exactly the mechanics of how they pulled that off.
Definitely. But to truly grasp the financial engineering here, we first have to establish what is actually moving through their supply chain. Because the food inside the boxes and the consumers buying those boxes, they look very different today than they did, say, 5 years ago.
Okay, let's unpack this, because if you're listening to this, you might still picture HelloFresh as just, that legacy meal kit brand. You picture the cardboard box arriving with the tiny bottle of soy sauce, a single scallion, and a little recipe card.
Right, the classic kit.
Yeah. But applying that label to them now is like calling Amazon just a bookstore. You really have to view their direct-to-consumer or D2C subscription model more like a streaming service for your pantry.
Yeah.
You aren't just buying Tuesday's dinner, you're subscribing to this highly flexible, algorithm-driven ecosystem.
Yeah, the exact term they use in the report is a digital-first, fast-moving consumer goods company,
Mm.
or FMCG. And the portfolio is incredibly vast now. I mean, they certainly still operate the traditional meal kits, right? Like
Well, yeah.
HelloFresh, Green Chef, every plate.
You have the staples?
Exactly.
Hmm.
But the aggressive expansion recently has been into the ready-to-eat market, the RTE space,
Mhm.
with brands like Factor and YouFoods.
And it actually doesn't even stop at human dinners anymore.
No, it really doesn't.
They've systematically acquired and built brands to capture every corner of your household budget. They deliver premium meat and seafood through a brand called Good Chop. They've tapped into the super lucrative human-grade pet food market with the Pets Table,
Oh.
and they're even moving into dietary supplements with Factor Form. It's basically a strategy to completely bypass the physical grocery store.
And that mechanism, the one that allows them to bypass the grocery store, that's the key to their entire operation. It's a strict make-to-order system.
Make to order. Okay, break that down.
Well, think about traditional grocery shopping for a second. A supermarket operates on a make-to-stock model. They're essentially just guessing how many bags of spinach or, cuts of salmon your neighborhood might buy this week.
Right. They just stock the shelves and hope people show up to buy it.
Exactly. They put it on a refrigerated shelf and hope for the best. Inherently, this leads to massive systemic food waste when their guesses are wrong. HelloFresh flips that entire equation. They move fresh ingredients directly from suppliers to custom fulfillment centers based on exact, algorithmically predicted customer orders.
So instead of a farmer shipping to a national distributor, who then ships to a regional warehouse, who ships to the back room of a grocery store, who finally puts it on a display, the ingredients just go from the supplier straight into a box that already has your specific name on it.
Precisely. The algorithm knows exactly how many households clicked on the spicy chicken tacos for next week. There is zero guessing, which theoretically strips a massive amount of waste out of the supply chain.
That makes a lot of sense.
What's fascinating here is how two massive kind of converging consumer trends are accelerating this whole D2C model right now. First, we're seeing this huge demand for hyper-personalization. Consumers are just moving away from a one-size-fits-all approach to eating.
Right, people want their specific diets catered to.
Exactly. They want meals specifically tailored to their precise health goals. Whether that means managing gut health, adjusting for specific dietary biomarkers, or just focusing on longevity, they expect precision nutrition. And a static grocery aisle really struggles to provide that.
Which entirely explains why they segment their brands so heavily. Like, if you want keto or paleo, you don't just search the main site, you get funneled directly into Green Chef.
Right.
But the second trend the report highlights seems to be fundamentally rewiring the food industry as a whole, and that's the GLP-1 effect.
Oh, yeah. The GLP-1 effect is arguably the most disruptive force in the food market right now. With the massive, widespread adoption of modern weight loss medications, millions of households are experiencing a drastic shift in their appetite and their nutritional requirements.
Because they just aren't as hungry.
Right, they are turning away from ultra-processed, high-calorie, empty-carb meals.
And it's not just about eating less overall, it's about the biology of a weight loss itself. Because when you lose weight rapidly on these medications, you are at a really high risk of losing muscle mass along with the fat if you aren't careful.
Yes, exactly.
So there is this sudden surging demand for nutrient-dense, high-protein and fiber-heavy meals to basically preserve that muscle tissue. People know they need more protein, but they don't necessarily have the time or the skill really to prep complex, macro-balanced meals from scratch every single night.
Precisely. They want that precise nutritional profile delivered directly to their door, already prepared. Ready-to-eat brands like Factor are just perfectly positioned to capture that specific demographic.
Okay, so the table is set. They have a massive portfolio of targeted brands, they have an algorithm predicting exact demand to eliminate waste, and they are riding the tailwinds of this massive high-protein GLP-1 boom. Everything looks perfect.
It does. On paper, it's flawless.
Which brings us to the core mystery of the 2025 annual report. Because if they are so perfectly positioned, why did their total orders plummet?
I have to push back here. In the tech and e-commerce world, the golden rule has literally always been about acquiring users at all costs. You grow market share relentlessly and worry about profitability later. Are they basically signaling that the era of sheer volume is dead? They are strategically putting a nail in the coffin of the growth at all costs era. I mean, let's look at the trajectory here. Overall group revenue dropped by nearly 12%, landing at roughly 6.6 billion euros.
Wow. 6.76 billion.
Yeah. And even if you filter out the noise of currency exchange rates, it's still about a 9% drop. And the total number of physical orders processed, that dropped by over 12.3%, down to about 100.5 million orders for the year.
Losing 12% of your total order volume in a single year sounds like an absolute disaster. If a traditional retailer lost 12% of its foot traffic, alarms would be ringing everywhere.
Oh, absolutely. It looks terrifying until you actually examine the mechanism of their customer acquisition. Because in mid-2024, the company made a highly deliberate pivot.
A pivot to what?
Well, they analyzed their retention data and realized they were essentially trapped on this hamster wheel of marketing spend. They were paying massive acquisition costs, through aggressive digital ads and steep introductory discounts to attract what we call flaky customers.
Oh, okay. The people who sign up just to get like the 60% off coupon for the first 3 boxes, and the moment the boxes return to full price, they just hit cancel.
Exactly. Churning those low-value customers was simply burning cash. So management made the decision to just stop chasing them. They heavily reduced their marketing spend. They pulled back on all that aggressive discounting that was designed merely to juice the top-line order numbers. They intentionally shrank their own customer pool.
So it's basically the quality over quantity approach applied to a massive logistics network. You are trading a large volume of unprofitable boxes for a smaller volume of highly profitable ones.
Yes. And we can see the mathematical proof of that strategy working in a metric called average order value, or AOV. Even though significantly fewer people ordered from HelloFresh in 2025, the AOV actually increased by 3.5% in constant currency.
Meaning the core audience that stuck around was spending more money per transaction.
Yes. By not catering to the bargain hunters, the cohort of customers they retained proved to be highly engaged. These loyal subscribers were routinely buying premium add-ons, adding extra protein portions to their meal kits, and increasingly shifting toward the higher-priced, ready-to-eat meals.
And in nurturing those long-term relationships yields a significantly higher return on investment. I mean, you don't have to keep paying Facebook or Google for ads to win over a stranger who will abandon you next week. You just offer a premium steak add-on to the customer who has already been ordering every week for 2 years.
It fundamentally changes the underlying economics of the business. But trading empty volume for high margin value is a terrifying leap for a publicly traded company. because it inevitably results in those scary headlines about shrinking revenue.
Right. But here's where it gets really interesting, though. We've established that they squeezed more money out of a smaller, more loyal customer base. But how does that translate to the actual bottom line? Because you can have a fantastic average order value, but if your warehouses are a mess, you will still lose money.
Oh, for sure. Operations are everything.
And despite the 12% drop in orders, their core earnings, what they refer to as adjusted EBITDA, actually increased by 5.8%, reaching 422.8 million euros. How do you lose millions of orders but grow your core profit by that much?
You do it through a massive structural overhaul that they dubbed the efficiency reset. Management recognized that after a decade of hypergrowth, constantly expanding to meet endless demand, they had accumulated a lot of operational bloat.
Just inefficiency everywhere.
Right. And since they were deliberately forecasting lower, higher quality order volumes moving forward, they didn't need the same sprawling infrastructure anymore. So they targeted 300 million euros in structural cost savings.
300 million euros is a staggering amount of money to carve out of an active supply chain. What does right-sizing a footprint actually look like on the factory floor?
It means ruthlessly identifying and eliminating inefficiencies. They closed down fulfillment centers that were built for phantom growth that was just no longer part of the strategy.
Okay.
And in the centers, they kept running specifically in Germany, Austria, Switzerland, and the UK. They heavily invested in automation. They replaced manual packing and sorting with automated systems, which vastly increased their direct labor productivity. Fewer people were needed to pack the same number of boxes.
That makes sense.
Furthermore, they looked at entire geographic markets that were underperforming, specifically Spain and Italy, and they simply pulled the plug. They initiated the process to completely exit those countries because the long-term path to profitability there just wasn't viable.
They just cut the dead weight. And because of these massive structural cuts, the original legacy meal kit segment transformed into a literal profit engine. Just the meal kit side of the business alone soared to a highly profitable adjusted EBITDA of 634.2 million euros. That is a massive margin improvement.
It was a huge triumph for the traditional meal kit division. It really provided an incredibly stable baseline for the company. However, while the meal kits were achieving this operational stability, the company hit a severe roadblock in their ready-to-eat segment, specifically within the United States.
Oh, really?
Yeah. In stark contrast to the meal kits, the RTE segment actually lost money in 2025, posting a negative adjusted EBITDA of 23.6 million euros.
Wait, I need to understand the mechanics of this. The ready-to-eat meals brands like Factor are the exact products perfectly aligned with the GLP-1 trend and that demand for hyper-convenience we just talked about. If the market is practically begging for high-protein microwavable meals, how did that specific division manage to lose money?
It was a classic collision of rapid scaling and regulatory red tape. They were aggressively expanding their production sites to meet the soaring demand for Factor meals, particularly in Arizona. But during this expansion, they were hit with sudden regulatory classification changes by local authorities.
Okay, but this isn't just a matter of filing new paperwork, is it? Like, if a health inspector reclassifies a massive commercial kitchen, that requires physical, operational changes, doesn't it?
Exactly. It fundamentally bottlenecks the entire operation. Because of the new classification, they were forced to undergo sudden, extensive recipe shelf life testing. You can't simply cook the chicken and ship it anymore.
Right.
You physically have to hold back thousands of meals, leave them in a controlled environment, and run lab tests for 7 days to conclusively prove to the regulators that the food remains safe and fresh under these new compliance standards.
Oh, wow. So suddenly, a high-speed production facility is acting as a holding cell. That completely destroys the efficiency of a fresh food supply chain.
It caused a massive ripple effect. To ensure safety while stabilizing this compliance side, they had to temporarily increase the recommended reheat times for the meals.
Oh, no.
And even worse for the consumer, they were forced to severely reduce the novelty and variety of the weekly menu. They had to stick to a narrow range of thoroughly tested recipes.
And if you are a customer paying a premium for a chef-prepared meal, and suddenly the menu gets repetitive, or the texture of the chicken changes because the reheat instructions were altered, you are going to cancel your subscription.
Which is exactly what happened. In the first half of 2025, their manufacturing costs inflated massively due to the bottlenecks, product quality took a perceived hit, and customer sentiment tanked. They had to pour time and capital into fixing the operational foundation of those Arizona kitchens before they could even think about returning to growth.
That sounds incredibly stressful.
It was. But if we connect this to the bigger picture, this Arizona crisis actually highlights the genius of their broader corporate strategy
How so? It sounds like a total disaster.
because of the efficiency reset. By fixing the foundation of the meal kit business first, they created that 634 million euro profit engine. That massive surplus from the meal kits acted as a financial shock absorber.
Ah,
It essentially subsidized the expensive, messy operational growing pains of the ready-to-eat expansion in the U.S. If they hadn't been so ruthless about cutting costs and automating the meal kit warehouses, that regulatory stumble in Arizona could have been catastrophic for the entire company.
right.
It's basically a flywheel effect. Stability in one mature vertical funds the volatile, necessary innovation in the newer vertical.
So what does this all mean when we look at the actual bank accounts? Because, accounting profits, like adjusted EBITDA, are great for corporate spreadsheets and earnings calls. But how did this wild operational roller coaster impact the actual cash flowing in and out of the business?
The cash flow statement actually tells the most reassuring story for the company in 2025. Despite the intentional drop in overall revenue, the cash generated directly from their daily operations actually increased to 297.4 million euros.
Okay, wow.
This is crucial because it proves that the underlying day-to-day business of selling food is generating real, tangible cash. And even more importantly, their free cash flow, which is the cash left over after paying for all the necessary capital expenditures to maintain the business, that nearly doubled to a positive 18.9 million euros.
Okay, I hear that the daily operations are generating cash. But looking at their balance sheet, their total cash reserves dropped dramatically. They went from having 486.7 million euros in the bank in 2024 down to about 211.1 million by the end of 2025. If the business is generating cash, where did over half of their cash reserves go?
They use that accumulated cash to aggressively clean up their balance sheet and reward their investors. Because management had absolute confidence in this new, leaner, cash-generating model, they just didn't feel the need to hoard a massive cash buffer anymore. First, they allocated 132.6 million euros to buy back their own stock.
Which is a classic signal to the market that the company believes its shares are undervalued and that they, really believe in their future profitability.
Precisely. Secondly, and perhaps more importantly for their long-term health, they took 137 million euros and completely paid off a convertible bond from 2020 that had come due.
So they essentially paid off a massive corporate mortgage. They completely removed that debt pressure.
They eliminated the debt without needing to refinance at today's higher interest rates. So they bought back equity and paid off their debt, leaving them with an incredibly pristine balance sheet. Operating a tech-enabled logistics company that generates positive free cash flow and doesn't rely on borrowing money to survive is a highly enviable position in the 2025 economic landscape.
Yeah, they survived the transition. And from what I understand in the report, because they are now operating this lean machine, they aren't just sitting back. They have initiated a program they called the Refresh.
Yes, the Refresh is billed as the largest product reinvestment in the history of HelloFresh. Because they executed the efficiency reset so successfully, they are taking those structural cost savings and directly funneling them back into the customer experience.
So what does the Refresh actually look like for you, the listener, when you open your front door and unpack that box?
It means a radically better food experience funded by operational efficiency, not by taking on new debt. For the customer, it translates to better quality proteins. It means introducing organic options for dairy and meats. It means larger portion sizes to satisfy that high protein demand we talked about. They're massively expanding the menu variety, for instance. They're doubling the weekly meal options for the Factor brand. They are also investing in service flexibility, giving customers the ability to request weekend deliveries, which was a huge logistical hurdle in the past.
So by getting rid of the flaky, discount-chasing customers and by automating the bloated warehouses, they can actually afford to give their loyal core audience premium, organic chicken and weekend delivery without destroying their profit margins. It is a textbook example of corporate capital discipline translating directly into tangible consumer value.
Exactly. It's a leaner company offering a better product to a smaller but far more dedicated audience.
Okay, let's pull all of these threads together for a quick summary. Over the course of 2025, this company executed a strategy that feels completely counterintuitive to the modern tech era. They deliberately shrank their overall customer base to weed out bargain hunters. They tightened their supply chain, closed underperforming facilities, and automated warehouses to carve out 300 million euros in savings.
Yep.
They utilized the massive profits from their legacy meal kits to survive a brutal regulatory bottleneck in their U.S. ready-to-eat kitchens. They paid off hundreds of millions in corporate debt. And ultimately, they managed to squeeze significantly more profit out of a smaller, fiercely loyal core of subscribers who are hungry for hyper-personalized, health-conscious convenience.
It is a remarkable turnaround narrative. It represents a fundamental shift away from the era of relentless empty growth toward an era of relentless efficiency and profitability. And this raises an important question, one that stretches far beyond just the balance sheet of one food delivery company.
What's that?
Well, throughout this deep dive, we've explored how algorithms are perfectly predicting customer demand to eliminate supply chain waste, and how AI is being used to design highly specific, biologically targeted menus. As artificial intelligence gets exponentially better at predicting exactly what you want to eat on exactly which day in the exact portion size you need to hit your personal health goals. Well, will the age-old act of going grocery shopping eventually shift from a weekly mandatory chore to just a niche nostalgic hobby?
Wow.
Will we eventually look back at the act of pushing a metal cart down an aisle containing thousands of items we don't need, trying to guess what we might feel like eating next Thursday as an incredibly primitive, wasteful way to feed ourselves?
That is a wild thought. Like, you would go to a physical grocery store the way you might go to an antique market or a vinyl record shop today, just to browse for the tactile experience, not because you actually need to source your survival from it. That entirely reframes that standoff with the open refrigerator we talked about at the beginning. Maybe in a few years, that fridge won't be a source of stress at all. It will just be perfectly automatically stocked with exactly what you didn't even know you were craving, shipped directly from a fulfillment center.
It's certainly the highly efficient, personalized future that this industry is betting billions of euros on.
Well, that is all the time we have for today's deep dive into the underlying business of what we eat. Thank you for joining us, and we will catch you on the next one.